All right. Hello, everyone. Happy Monday. Welcome to your weekly market check-in here with myself, Greta Wall. I'm your host, and I'm joined by Derrick Oldensmith, the head trader at T3 Trading Group and leader of T3 Live's Pro Desk virtual trading floor. Before we get into any market-related discussions, here's a quick disclosure of Derrick's positions as of our recording here today on June 1st. The first of a month on a Monday, like that can't fall any better for traders, I think, Derrick. So happy Monday, happy June. Feels like we're getting into official summer here. Title of our stream today being a key jobs week, and it is, but there's also a ton of other news happening this week. So we'll start with the job stuff, and then we'll kind of move on to the other stuff. But first, how's your Monday and your start of June going for you so far?
It's going well. If it wasn't for trading the space Virgin Galactic SPCE on the short side, it'd be a very slow day, honestly. But this has kept me very busy. There's been a lot of price action in that name. It was up like 40% at one point earlier, then it went negative, and now it's back up 15%. So the stock has just been all over the place on a big day. Three to the upside, super, super extended, large float name. So it has been a pretty fun one to trade.
All right. Let's talk about the jobs data. Obviously, the first Friday of the month, we're going to get the May NFP report on Friday, but there's also a lot of other data this week around the labor market heading into that. Just pulling up my calendar here to see what day is what. Job openings on Tuesday, obviously the ADP private employment report on Wednesday, weekly jobless claims on Thursday. We get that every week. And then Friday, the NFP, the big one, with the unemployment rate as well included as part of that report. Do you think this jobs report is more important, less important? What compared to previous reports? We do have a Fed meeting in a few weeks. So what do you think?
Yeah, so I mean, obviously, every jobs number carries some degree of importance. We want to make sure the job market's not deteriorating, but the economy's been going really well. The job market is held in. My concern is really right back on the inflation side. I just grabbed it here. I'm back in New York City. Back in New York City for the first time this year. Actually, I got here on Thursday night last week. Only here for a handful of days, and I'm going to Oregon for a couple of weeks. But then I'll be back in New York for more or less the rest of the year. But I just grabbed lunch from my local deli over here by my apartment in the East Village, and I noticed numbers. So I just happened to notice that my sandwich, my go-to chicken parm hero, was about 15% higher in price than it was back in December when I was last year. And look, I can afford it. It's not the end of the world for me, but we increasingly have a K-shaped economy that's being further brought on by this inflation issue. We're seeing core inflation numbers back over 3% again. We're seeing Warsh, the new chair of the Federal Reserve, coming out saying that he just wants to change the way in which we measure inflation. I was having a read through on the adjustments that he wants to do, and it's something that I honestly completely disagree with. But when you don't like the rules of the game and you can change the rules because you have enough power, that seems to be what they're doing. So the jobs market is important. We need to make sure it's not deteriorating, but we're starting to really have an inflation problem. And look, food inflation, what I'm complaining about right now with my little sandwich that I just got, that's not in the core numbers. It's not really anything we can do about energy. Well, it's not anything that the Fed can do, the Federal Reserve can do about food and energy inflation. There's some things that the U.S. government could do or could have chosen not to do. But that's the bigger concern right now. I don't see how we can cut interest rates. I actually don't see how we don't hike interest rates at this point, based on what these inflation numbers look like, unless, of course, you again want to change the way in which we measure inflation, which doesn't really benefit anybody, to be honest.
Yeah,
So
yeah. It is important, I think, to note that this will be Warsh's first meeting as chairman. So it'll be really big for the market to get a look at who he's going to be as chairman and to get a read on that because it will be his first official press conference and all of that after the meeting. So definitely a big one. All right, let's talk about. I want to talk about Nvidia, and when we talk about Nvidia, As of this week, we've got to talk about Intel, AMD as well, because NVIDIA over the weekend announced a new chip for Windows computers. So good news for Microsoft, good news for NVIDIA, not so good news for Intel, AMD, competitors in that space, because NVIDIA previously wasn't making chips for laptops. But, you have NVIDIA up today. It's Dell. Dell was up, still up. Okay, Dell's up quite a bit today. Microsoft as well, and then like I mentioned, Intel, AMD. So, what do you think about the announcement from NVIDIA and what it changes in the chip maker space moving forward?
Sure. So all the NVIDIA announcements were really important coming into today's trading session. It seems like almost all of the market movement that we're having is related to NVIDIA's announcements this morning. So NVIDIA is up 5%. I'm long the stock. It gave a great opportunity to buy in that 210 area just late last week when it created a pivot low. So I'm now, $20 in the money on those purchases. Sorry, $10 in the money on those purchases. I'm looking for another 10 from here to get to my target. NVIDIA continues to almost like the anti-SOXX, the anti-SMH. NVIDIA has been green all day today. It's up 5% right now. SOXX was negative for much of the day. Now it's up 0.5%, which is not a big deal at all. A lot of the times we're seeing NVIDIA kind of act as a cash register for the other semiconductors, but this news more directly impacted names like AMD and Intel, like you mentioned. And then you continue to have also the incredible up move in the memory names, though. You got Micron up 7%, and you got SanDisk up 4%, and you got the Korean market, South Korean ETF up 4% again this morning as well. So yeah, I mean, that just continues to be really important. I continue to be really bullish overall on the semiconductor space, but I'm paying attention to relative strength and relative weakness, and I'm paying attention to extension. So I'm bullish. I actually was trying to buy some SMH today, but I was a little bit cheap. Again, if you're not willing to pay up in this market, it seems like you never get stock. I was looking for a little bit of a pullback. It's like 590 in SMH. Start buying a little bit. The low is 593. Now it's at 608. So when it comes to these semiconductor names, just continue to buy every dip that's been the play. But honestly, the biggest announcement from Jensen Huang in some ways almost seemed to be when he came out and said that, like, basically, don't worry, software is still important. It's not going anywhere. So you have the IGV ETF, which had gotten so beaten up back in February and March. They just crushed this thing because they said, we're not going to need software anymore if we have AI. And Jensen came out and said, this is really important. This is after software was already doing better. So now we have a massive day 3 to the upside of the IGV ETF. It's up 5.5%. We had a really important earnings announcement from Snow last week, from Snowflake, which is now on its big day 3 to the upside. It's up another 9% today. But what we really saw from the Snow report and why it was so important was it kind of confirmed the thesis we had a few months ago. We were saying, look, they're kind of throwing the baby out with the bathwater when it comes to the sell-off in the software stocks. Some software stocks are going to be able to embrace AI. They're going to do really well and maybe even better because of AI. Others will get put out of business if they don't properly adopt their business model. And everything that we saw with the Snow report was about how they're harnessing AI, how it's better for their business. And the stock was up, I forget, 35% on the earnings day. And then it was up probably another 10% or something like that on Friday. It's up another 9% right now where we're talking. I mean, this has just been an incredible, incredible move from Snowflake because they're proving themselves to be the winner. And on a day like today, when the SPY is mainly going sideways, fluctuating between flat negative and flat positive, we need names that are moving and names that are in the news to keep us paid. So it's been NVIDIA, it's been Intel, it's been AMD, it's been Dell, it's been all the software names, it's been these one-offs like Virgin Galactic, like I already mentioned, moving dozens of a percent at a time. That's what and that, by the way, is why it's so great to be a stock trader as opposed to someone who just specifically trades indexes. Because if you only trade the SPYs, I mean, they look so sloppy and boring today, whereas all these other names are continuing to move and there's opportunity there.
Yeah. Like you said, so much of the movement that was happening in the market today was really linked to all of the news and announcements from NVIDIA. You and I have talked in the past about how NVIDIA isn't quite the stock of the market as like it used to be. But then today, I feel like it just cemented itself as I do still control this market and I can move the whole market based on my news. So, what do you think about the influence of NVIDIA on the broader tech space um, after today?
Sure. I mean, look, NVIDIA went into a range between.
Yeah. Do you have chart? Do you want to share charts?
Sure, I can throw up some charts. Cool, should be visible now. Um,
Yep.
NVIDIA went into a range for 1, 2, 3, 4, 5, 6, 7, 8. It was in a range for 9 months. It's a long time. We're stuck between 165 and a little bit under $200, $197, something like that. So I mean, this thing was never going to be dead. It's the largest market cap company in the history of the universe. But 9 months of sideways price action doesn't necessarily leave traders a lot to do with. We have to
Hold on,
remember though.
Derek. We're looking at your four charts, your SPY
uh,
Qs, IWM.
Boom.
There
There
you
you
go.
go.
There's NVIDIA full screen. Yep.
So again, 9 month range here. So when you go through this much of a range, it doesn't leave traders a lot to do with. But what we have to remember about the stock market and individual stocks, or really any trading instrument, is that markets work in periods of expansion and consolidation over time, right? So you go through a long consolidation period, then you have a breakout. You go through a long consolidation period, you have a breakout. You go through a long consolidation period. In this case, then you have a bigger dip. Then you have a breakout. You go through another 9 month consolidation period. We had a little bit of a dip along with the rest of the market at the beginning of the Iran war in March, and that has now led to a massive breakout. This is trending higher. It looks like it wants to continue. NVIDIA still trades cheap from a multiple basis because people are concerned about its size and that they're not going to be able to innovate. But look, they just announced a I think it was $60 billion buyback on that last earnings report. I mean, what else do I have to say? Apple on its last earnings report announced $100 billion buyback that was back here. So you could say, hey, all the funds already own it. There's no one left to buy it. But guess what? The company themselves is going to continue to buy it. And there's really something to be said about shrinking floats for individual stocks or shrinking floats for the stock market as a whole. And there's no reason to think that the AI super cycle is going to be stopping anytime soon. It is something we have to pay attention to in case CapEx were to ever pull back, which I'm sure someday that'll happen, but I don't know that if that's going to be in 2026 or 2030 or 2035. So we have to pay attention to that as a potential risk. But the stock doesn't even trade that cheap. So the float's going to get smaller. They're going to buy back their own stock. I think the AI super cycle is still ongoing. I want to buy every dip. And that's what we did. We had 3 down days in a row here. Day 4 was this doji through 210, which is the level that we were watching. It closed good enough. A little bit of a concern with how it closed on Friday, but it never breached that low. Got hit with all the new news over the weekend, and now we're continuing. And it's the same thing with the semiconductor ETFs. I don't want to chase price. And in fact, on the 27th, which what week was that? That was Tuesday last week. The
Wednesday.
SMH and particularly the SOXX were going parabolic. The gap higher pre-market was even higher than this. These things were completely going parabolic. And at that point, you don't want to buy it. You could potentially put a cute short on. We did. We had a great day trade short from those pre-market highs down through lows, green to red. But look at this thing. This thing is so strong that it can't even price correct through the ADMA. It can't even price correct down through equilibrium. Instead, it just goes sideways for 3 days to set up the next bull flag breakout. That's the environment that we're in. And if anything, the hardest part about this market is that it really forces you to pay up to be able to get longs. Like I said, I thought I was being fairly conservative. I was like, all right, I'll start to nibble on some SMH long at 590. I couldn't even get that far down today. And that's with AMD being smoked. It's with Intel being smoked. But no, they just rotate to NVIDIA. They buy more Micron. And the dip this morning couldn't even really get me to the ADMA on the daily chart to reestablish my SMH long. That's just the environment we're in.
Good stuff. All right. You, as a trader, pay a lot of attention to market dynamics, timing, seasonality, etc. Something that might change market dynamics is coming this week, Thursday. They're deeming it Trader Independence Day, Trader Freedom Day, however you want to refer to it. But with the SEC, the pattern day trader rule is, the ruling goes into effect this Thursday, June 4th. Tasty Trade has said they're implementing their changes immediately. Schwab is going to have changes implemented as of June 8th. Other brokers have announced different timelines, but they all have about, I think, a 12-month timeline to get it done. But I assume if there's competition in the space, obviously they're going to all get it done as fast as they can. So when it comes to this change in the market, if anyone watching us isn't aware, pattern day trader rule is that to make more than 3 trades in a 24-hour period, you have to have over $25,000 cash in your account. So it doesn't affect people like Derek or other prop traders, of course. You have much more capital than $25,000 in your account, and you're backed by a firm, etc. But it definitely changes the retail trader space and what they can and can't do on a 24-hour basis, on a day trading basis. So how do you think this will change the market dynamics, the kind of moves you see in meme type stocks? Because those are the stocks that people are, will tend to go toward.
So I'll be honest, I'm in the minority. So first of all, I don't know. I really don't know. We have to see when things start moving, if everything seems to be really different or not. I can tell you that my take on this, which is not a strong take, is very different than most of the good traders that I know. Most of the good traders I know think that this is going to have a big impact. They think that it's really going to move like these Wall Street bets types of names, these short squeeze types of names, the cheaper stocks and the lower float names in particular, and that's going to further stretch the rubber band, if you want to call it, of how extended a stock can get and things like that. I personally don't think it's going to have that much of an impact. And again, that take is in the minority, and I could definitely be wrong. But look, most people that really want to day trade are already day trading. Most people that really want to do short-term trades are already putting on short-term trades. Now we're going to open it up so that people with $3,000 in their account can put on trades. Can that have impact? Yeah, it can have impact, especially, I guess, if it's a lot of them all in aggregate, all at once. But I really don't think it's going to be enough money because I think that most people who want to be doing that are already doing it. And I also think that the people with those super small accounts are just going to blow up so fast that it's very quickly going to turn into a non-event, even if it is an event in the beginning. I highly disagree with these changes of these types of rules. They're in place for a reason. They're in place to protect people. If you don't have more than $3,000 to your name, you don't belong short-term speculating on the market with the last $3,000 that you have. I mean, this is ridiculous. But look, I tend to be like a small government type of person, but I do think that there is room and reason for regulation. The purpose of regulation is like to save us from ourselves. And that's why, again, as a general rule, I would prefer small government. But when we talk about certain rules that are in place to protect people, like the S&P 500 inclusion rule that we're now changing at the whim of Elon Musk to allow SpaceX to become a part of it, or allowing people who only have a couple $1,000s to be able to start day trading the stock market, this all it does is it hurts people. This isn't going to protect anyone. This is silly. So, it's something that I'm against. I think that people are going to lose money. And once they quickly lose that money, then they're going to not have any impact on the market because you went from having $3,000 to having $0. Now go get a job.
All right. There we go. Derek's take. All right, Derek, I mentioned at the beginning it's June 1st on a Monday, which is a nice round start to the month. Let's talk about May. The typical, sell in May and go away doesn't seem to have happened this May. So a seasonally a bit different of a May. So review your own trading in May for me really quickly, and then also what you think about the overall market action in the month and what it could mean moving forward.
Sure. So first of all, sell in May and go away is a little bit of a misnomer because May actually is historically a pretty good month for the stock market, especially the first half of May. Where you begin to see some weakness is June and August, and then July also tends to be a really strong month historically. So I'm just going entirely based off my head. That's what I remember. I probably will be redoing my research on the specifics of some of the seasonality aspects as we move throughout the summer. But yeah, my month of May was really solid. I had a frustrating April. So let's pull my chart back up. I don't know if you want to reshare it for our listeners here, but April was a very frustrating month for me because I was extremely bullish and I honestly did not do well. And the reason that I did not do well, and I'm sure I've spoken with you about this in the past, Greta, was even though I was bullish, the market actually just went too far too fast. That was the hardest thing about April. This was the fastest rally, and it continued through May. This was the fastest rally in the history of the stock market that was not coming from a bear market. I don't really trade for one-off situations. I trade based on probabilities. And the probability of something happening that has never happened before in the history of the stock market tends to be relatively low. We always have to be prepared for it. We always have to be able to manage risk. So I'm not necessarily saying that April was a bad month for me, but I'm saying it was a frustrating month because I felt like I really underperformed given how bullish I was. Because the market went up so far so fast that I was trying to short things. I was trying to hedge the extension. I was trying to get pullbacks off the extension. Not only did I never got them, but then I was just losing money and losing money on extension shorts. And I've got some rules in place on how I measure extension. And this was a period of time. Again, we always work on probabilities when it comes to trading, where following those rules cost me money and I lost money. And I was really asking myself in April, like, what has changed about the market that enabled this to happen? What could I have done differently? What other pieces of information could I have implemented into my thought process to have a better performance in that month? And then coming into May, I made those adjustments. And May has turned out to be, even though the market has gone up less than it did in April, a great month for me just because I'm evolving with the market. I'm making adjustments. From my experience as not just a trader, but a manager of other traders here at T3 I started my own trading desk at our downtown New York City headquartered trading floor in 2013. So it's been 13 years now that I've been managing other traders. When it comes to entry-level traders, the number one reason why they fail and why they're not successful is because they fail to manage risk properly and consistently over time. When it comes to experienced traders, the number one reason why a really good experienced trader might all of a sudden not have success anymore is because the market environment changed and that trader failed to adapt and adjust appropriately to those changes. And I know that. So here I am seeing a unique situation play out in April, and I'm not just going to do the same things over and over and over again if there's potential changes in the environment. So made some adjustments to my rules, particularly the aggressiveness, the timing on how I get into what I call extension shorts, which are shorter term trades. And it's led to me being a little bit more conservative in some of those areas, but it's also worked out really, really well while maintaining my general bullish tilt on the market, which has obviously worked out really well as we sit here at all-time highs again for June 1st.
All right. From a comment we got from YouTube, somebody asked, what are Derrick's rules on extensions? Can you go over those?
Sure. So when it comes to the indexes, particularly the SPYs or the Qs, first of all, the way that I measure extension is how far removed the stock or the market that I'm looking at is from the space between the 8 and 21 EMA. So in an uptrending market, the 8 EMA is what I call the upper band of equilibrium. The 21 EMA is what I call the lower band of equilibrium. So technical market equilibrium is the price band between the 8 and 21 EMA. So for the daily chart and the SPYs, right now as we're having this conversation, it's basically 750 spot 83 down through 738 spot 95. That's equilibrium. In a downtrending market like we had back here in March, the 80 EMA becomes the lower band of equilibrium, and the 21 EMA is the upper band of equilibrium. And once again, the equilibrium zone is basically going to be the space between. So when the market is trading like at the 80 EMA or in between the moving averages, it's trading at equilibrium. When it's trading above or below, it's extended to some degree. It might be extended by 2 pennies, which is completely meaningless on a $757 ETF, or it might be extended by $25, which is going to be significantly more meaningful because you'd have very significant extension at that price. So generally what I do to keep things easy is I have price ranges and categories. So I've got 3 price ranges, 3 categories. If the market is basically trading between the 80 EMA or a penny above the 80 EMA through $7 above the 80 EMA, which is pretty much where we are right now. We're basically $7 or $6.90 above the 80 EMA. That's like what we could call zone 1, which I consider to not be extended at all. So it's not extended at all. You could still buy this market here. We're getting right to the upper band of that at $7, but you can still buy this market here and feel comfortable that you're not chasing price by too much, that you can still have a good risk reward for trend following continuation. When you get between like $7 and $15, that's what I call no man's land. When you're at $7 to $15, it's a bad risk reward to put on new longs because you are now chasing price. You could have a very healthy technical pullback and lose a bunch of money because you bought at such a bad price. It's just a bad risk reward for trend continuation. But it's also not a good idea to short. You're fighting an uptrend. You've got a moderate degree of extension, but that extension is not extreme enough to really consider going the other way. And then finally, $15 and above away from the 80 EMA is what we consider to be extreme extension. At extreme extension, it means to the upside, no new longs, and potentially consider going short, going the other way for a shorter term pullback because of how extended that the market has become. Now, first thing I would say is that those zones I just described, those are guidelines. The right way to do this is actually really to do it based off of percentages. But instead of just doing constant percentage math, I find that just kind of breaking it up into these zones is really beneficial. As the ETF gets more expensive over time, then you need to adjust those adjust those zones. There was a time when I considered anything above $10 of extension to be extreme extension for the SPYs. Now it's 15. Arguably, after this last move we've had here over the course of the last month or so, I should probably raise that a little bit further to $17 or $18 as my now extreme extension point. But that's not the point. The point is that it's a guideline that I like to pay attention to when I'm trading that helps me to be able to identify risk reward. All right, we're in an uptrend. We're not very extended. I can be buying bull flags. I can be buying dips. I can be buying pivot lows. I can be buying for continuation. All right, we're in the no man's land zone. If I put on any new longs here, I got a bad risk reward. It's too chasey, but the trend is your friend. Everything's very strong. I don't want to be going short because I could get completely run over. All right, now we're at extreme extension. That means that as a hard rule, no new index related longs. You have a terrible risk reward, but I could potentially put shorts on in this area if I get the right signal to capture a technical pullback that will inevitably have to happen through time or through price to satisfy the extreme upside extension that we have. And what made April just so unique was that we stayed in extreme upside extension just day after day after day in this up move here for like 5-6 trading sessions in a row without any price correction, without any time correction. Sometimes you'll see that happen for 2 days. Sometimes you might even see it happen for 3 days. I don't think I've ever really seen that happen for more than 3 days ever, except for coming out of some deep bear markets again, like the COVID period. But that goes hand in hand with the fact that this was the fastest rally at the index level, especially with the NASDAQ, fastest rally at the index level in the history of the stock market where we were not in a bear market. So hope that helps.
Yeah, great. Anthony, I see your questions from YouTube. Anthony said he's looking to get into T3 trading, so I'll have a link for you in just a bit to do that. But he also asked can you please explain how you review your trades/journals? I know at this point in your trading, you're not really journaling on a daily basis, but how do you, as a trader, Derrick, look back on your trades and review to improve? Because I know you are always, assessing what you're doing.
Sure. So the first thing I would say is that when a new trader joins the team, they get access to the training program I put together. The training program consists of a series of about 15 video lectures that cover a variety of trading related topics. The reason why I'm bringing this up is because I have a whole class on journaling in the training program. It's probably an hour-long class or something like that. So highly recommend for anybody who is working with me or considering working with me, dive into that journaling class when you get access to it, because it'll be able to give you a significantly more detailed explanation of what I think is important compared to, I don't know, just turning your computer off at 4 o'clock every day. With that said, I got to be honest, I really don't journal anymore. I've been trading professionally with T3, like I said, for 16 years. I always know pretty much right away what I'm doing correctly, what I'm doing poorly, and my game plans and my strategies are just so uniform at this point in my career that it doesn't really require me to make those sorts of reviews. So the sorts of reviews that I'm doing now is just like I just knew that I underperformed in April, and that's why I was frustrated. I need to ask myself, well, what changed? And honestly, part of it also comes my review in some ways is my doing our team afternoon meeting every day. So I do this afternoon meeting every day where I review what the market did, how it met or did not meet the expectations that I had established in the morning meeting, and why. I try as best as I can to draw out real-time lessons from what the price action was so that everybody else on the team can learn. And as I'm doing that, I'm often reviewing what my thought process was, what my trading process was, what I traded, how my thought process changed. So a lot of that kind of acts as my review and my journal at this point, if you will. But I highly recommend for newer traders to do legitimate journals. I did them for years and years and years. I would journal every single trade that I do every day. Then I would do weekly journals on the weekend. Then I would do a month-end wrap-up journal that would be extremely extensive. I would spend 8 hours, 10 hours sometimes working on a monthly journal, compiling all these statistics and information of everything I did over the course of that entire month to help me improve as a trader. And while I don't do that anymore, I highly recommend for anybody who's new in the business to go about doing it. It's one of the best ways to make consistent improvements to your trading.
All right. Derrick is a real trader, so I do want to let him get back to that because, again, like I said at the beginning, he is the head trader at T3 Trading Group and the leader of our ProDesk virtual trading floor here at T3 Live. So for Anthony, who asked specifically for this, you can go to t3live.com/DOLive, fill out that survey there, and someone from the trading group team will get in contact with you to see how you could start working with them there and start working with Derrick on a daily basis. Again, he works with all T3 Trading Group traders inside that ProDesk virtual trading floor. That's where they all trade together every single day. Derrick, have a great rest of your day, a good week. Some big catalysts coming up. So hope you have a good week, and we'll talk next week.
Awesome. Thanks, Rhett. I'll talk to you next time.
Bye.